Good morning, ladies and gentlemen. Welcome to the ARGENTEX Group PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and we'll publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we'd like to submit the following poll, and I'm sure the company would be most grateful for your participation. And I'd now like to hand over to Director of Investor Relations, Mark James, Interim CFO, Guy Rudolph, and CEO, Jim Orman. Good morning.
Good morning, Mark. Thank you for that, and welcome everybody. We're pleased to have you at this webinar this morning. Jim Orman, CEO, joined the business in Q3 last year and have concluded the strategic review instigated by the board earlier in the year. Let me start this with an apology. We do intend to engage with shareholders properly going forwards, and we would ordinarily have had this session much sooner. But we could not do so. It would have been classed as a retail financial promotion as we were raising funds in the market. So forgive us that. We'll get into a regular cadence as we build our value story going forwards. Guy.
Thanks very much, Jim. Good morning. This is Guy Rudolph. I'm the interim CFO. Delighted to be with you this morning and looking forward to taking you through our results. Okay, if we move to company overview, please. There we go. So before we get into the results, I thought it would be worthwhile just reminding everyone who we are and actually how we made our money in 2023. So we are a high-touch, service-led currency management and payments and account provider. Our corporate customers are largely large corporates, medium-sized corporates, and institutional clients, so fund managers, and we support them in their currency management needs or FX execution hedging, primarily through three products: spot, forward, and structured solutions. And we have a small alternative banking business, which is nascent. Before we move on, I think on the right-hand side, quite important to understand how we make our money. And really a pretty simple message there in that we make about a third of our money or so from spots, about 2/3 or so from forwards, and the rest from options or structured solutions. But importantly, we make twice as much money when we make on forwards than we do on spot. We make twice as much money on options as we do on forwards. And as we talk through the presentation, that product mix, that sales mix is important.
Thanks, Guy. Very simply, the business has traditionally been an FX-only business. We're now broadening our horizons to improve quality of earnings, provide a broader range of products, and increase visibility of our clients' needs. So on to headline numbers for the year. We've already put trading updates out into the market around these, but revenue was flat year on year. Profit was down, very much in line with the updates that we released back at the end of 23 and into January. No final dividends declared this year or for the foreseeable future whilst we invest in growth. Happy to talk a bit more about that later. The good news in the underlying business is that we do have more clients that traded with us in 23 versus 22, and they were trading more frequently. But as Guy will come on to explain, the balance of trades has shifted more from forwards to spot transactions where we earn less revenues. And this in reality means that market dynamics do affect us as a business, perhaps more so than we've articulated in the past. So let's move to the next slide where we talk about operational trends in a bit more detail. And what you can see from these charts is that we have clients that are trading more frequently, but they're not spending as much with us as they have in previous years, which is a reflection of low market volatility and this general risk-off environment. We've seen a very significant shift in the balance of trades that our customers are wanting to make from forward to spot transactions, where we make half as much money. This is what's driving our outlook for this current financial year 2024. Very simply, low volatility environment. Clients don't feel the need to protect their cash flows to quite the same extent as they do when uncertainty and fear are driving sentiment. And this has a material impact on our ability to generate revenue opportunities if we remain a narrow business. This chart and this graph shows that very clearly. Our revenues clearly track and our margins and flows clearly track volatility overall as risk appetite in the market shows itself. And since the summer of 22, we've seen a marked deterioration in volatility overall. This demonstrates the value and the need to make our revenues more resilient with a more diversified product suite and a deeper service provision for customers, which will give us greater visibility of their client needs and also predictability for our future earnings. Let's have a look at the P&L.
Thanks, Jim. Just looking at the P&L, really, probably Jim has covered on revenue or flat revenues, but really digging into that a little bit more. Flat revenues, more clients trading at a low level of volume, and that really, particularly in the second half of the year, we saw a very significant shift from in the first half of the year in FY22, probably 60% forward and 40% spot, to the end of the year, 60% spot and 40% forward, and that mix really impacting that revenue. If we then now look at cost in a little more detail, and profitability down, that's really driven not by two main factors. The first, a 43% increase in our average headcount, predominantly in our sales capability and back office, and that back office being necessarily built to support us in a MiFID II regulated environment. And that depreciation amortization increase, the result of us expanding our office space in the UK so that we could accommodate business and also our premises in the Netherlands in the BV, and increased amortization on technology stack that we have. And that led us to having reduced margins. If we move through to the cash flow, positive that we end with net cash of 18.3 and a net increase of 2.1 net cash generated in the year. But really the principal movements in there, you see the expenditure on CapEx with our investment in premises and software, and also a 3.4 million of cash dividends paid in the year, which was the final dividend from FY22 paid in the first half and the 0.9 million interim paid there. So that kind of moves us from that net cash position onto a balance sheet. On our balance sheet, a strong balance sheet with a healthy amount of cash. You can see the increase on the fixed asset line that I've referenced to already from office space and investment in technology, and that net cash increase of 2.1 million. Now, at this point, it's probably worth explaining why, if we had that much cash on our balance sheet, we felt it necessary to do an equity raise to raise money to invest in the future. And I think over the next couple of slides, I want to explain something that probably hasn't been clear to many of our investors of our requirement, our regulatory requirement for cash and why we need to maintain that. So on this graph, keeping it relatively simple, the blue graph, the blue line, which is our liquid asset threshold requirement of 13.7, this is the amount of money that we're required from a regulatory perspective to hold, and that's determined by a whole sort of set of formulae, but largely by the FCA and our regulated business. Now that's the position at March, and if we move to the next slide, which I think I wouldn't want to be accused of cherry picking, because the gap between our liquid assets and our liquid asset threshold requirement, it's quite a mouthful, that one, changes every month. But really what we see here is that the amount of liquid assets we have depends upon margin calls that we have from our liquidity providers and from our customers, and the LATR is the amount that's required to support the underlying business from a regulatory perspective. And the important thing to realise with this is that this cash is the equivalent of our working capital, and it's what allows us to continue our core trade of actually being able to sell, be a broker and provide spots, forwards, and option solutions. So it really isn't free cash that we can distribute. It's cash that's necessary for our business, hence why we went for a capital raise to be able to invest and spend the money building for our future.
Thanks, Guy. The difference between regulatory cash and liquid assets, that headroom is what we use to underpin credit for our customers. We've always used that headroom in this way. It's how we generate revenue. It's important to preserve the availability of this cash. And so when we chose to make a significant investment in the development of new technology and products, the purpose of the raise, as Guy said, was to ensure that headroom was maintained and allows for that flux in volatility and those opportunities to generate revenues going forwards. So let's come on to strategy. We've obviously spent the last 6 months or so with our heads firmly under the bonnet. The underlying business has a very strong client roster. There are things, however, that we need to fix. And historically, the business has flagged investment in people, in places and tech, but much of this spend was not focused on revenue generation, but on infrastructure, necessary investment as a MiFID II business in compliance, in risk, finance, and basic technology, where historically, I think some of our competitors have been stronger. This cost base was allowed to increase without reliable revenue growth to support that investment, and we need to address this. We have a very clear plan. We need to prioritise investment that drives revenue rather than merely building infrastructure. And if we can come on to specifically how we intend to transform the business, we've historically been an agency sales business focused almost exclusively around FX. And when you're small, you can cover the cracks of growth and churn by hiring more salespeople, but this gets harder as you scale. That revolving door of recruitment spins ever faster, and keeping up with client churn often means you have to run much faster, even to stand still. We will diversify into a full financial payments and alternative banking platform, not just FX. And we're already seeing from the clients using these services today that it helps us gravitate closer to those clients and generates a greater wallet share for us. It also develops functionality that doesn't just deliver for banking customers, but also expands our FX platform into new areas of opportunity, including mass payments, e-commerce, and API connectivity. Frankly, historically, our systems and processes have been too manual, and growth meant adding extra heads in front, middle, and back office roles, which is why profit margins were being compressed. But by moving to a business model supported by automation, this will allow us greater operational leverage and ensure our profit margins don't come under so much pressure in the future.
Thanks, Jim. Over the next few slides, what we'd like to unpick is actually what are the three pillars and how are we going to transform the business from the as is today to the to be business that Jim's just outlined. I'll talk about what we plan to do from what we're calling our operational excellence pillar before handing back over to Jim to talk about product diversification and geographic expansion. From an operational excellence side of things, really looking at financial and operational efficiencies. First pillar, part of this pillar, it's really improving our cost control. This is a business that has grown significantly over a number of years, and as Jim has alluded to, the cost base probably has got ahead of the revenue. So we're really looking at reducing OPEX in the current year versus the run rate of 3 million. Looking at 1 million of staff cost cuts, and we'll do that through natural attrition. So we're looking very, very carefully wherever we backfill when a role moves on. And also looking at how we can restructure some of our sales commissions that we pay to our sales force and our dealers and bring those, making sure they are in line with industry norms and aligned to long-term value creation and support our clients. Second piece is licensing capital efficiencies, which is a much longer term play, but really keeping this quite high level. We want to look at the licensing structure in our business to make sure that we have it as capital efficient as possible from a regulatory perspective, whereas today we think this is suboptimal. Moving to the second piece, which is really about sort of a best-in-class customer experience and customer segmentation. So what does this slide tell us? Well, simply, our top 100 clients generate us 2/3 of our revenue, and we will continue to serve those clients with what we call a white glove service, being a trusted advisor, helping them broker the solutions to hedge their businesses and supporting them, particularly those businesses that can't afford full-blown treasury functions, and we can provide that deep expertise that they like and appreciate. But the other thing that shows is a huge opportunity on the remaining 1,800. The first is a development opportunity. Can we bring what of those 1,800 that we're potentially underserving today, can we bring into that top 100? But also, how can we automate and give a much more streamlined online service to those lower end customers versus the manual to high touch processes we have today?
Thanks, Guy. I won't dwell on this slide, but I think the importance of it simply is that you can see that the markets for banking and payments and FX are converging. They used to be served by very distinct providers in the past in different segments, but now there is an opportunity to coalesce that service provision across multiple jurisdictions and multiple disciplines, which is a real opportunity for us. More specifically, Clients in the institutional space, in particular, are demanding wider service provision, and banks are retrenching from this. And with the strong institutional book as we have, we're well placed to service this need. Clients who do bank with us are more likely to use us for FX and payment services. We're already seeing this, having launched virtual IBANs in a small number of jurisdictions last year, and there's so much more that we can do there. The development of a new alternative banking platform also takes us straight to automation as a business, which has huge knock-on benefits for scalability, but also service provision for our more traditional FX customers will benefit from a more automated platform that has better functionality and higher quality management reporting. So it works for everybody, but it's using revenue to drive those improvements rather than straight investment. Geographic expansion, it does what it says on the tin, but historically, as Guy said earlier, we've opened new branches on the next slide where we needed new licenses for those regulatory areas. We're not going to carry on doing that. We're going to spend time opening branches in territories where we already have regulatory approval. So across Europe via our hub in the Netherlands, the Middle East, where our process for licensing in Dubai is going very well, and Asia Pacific, where we've recently gained our regulatory approvals in Australia. So key targets around Europe for sure, but we will be opportunistic, expanding our reach with quality teams and, of course, a platform that's being brought bang up to date. Let us summarise for you before we go to Q&A. We've completed a very thorough strategic review to understand the business properly. We have a quality underlying business, but costs have been allowed to race ahead of revenues, and we are susceptible to market dynamics. We've got a very strong brand in FX, but we need to diversify into adjacent products and markets to improve our quality of earnings. We are coming off the back of significant change, we understand that, but we can go further and faster. And we've outlined the 3 pillars clearly that we want to implement to transform the business. Operational excellence, which Guy talked about in detail, providing better operational gearing, more products, which I focused on, particularly in payments and banking, something we haven't been historically strong in, and a larger geographic footprint in territories where we already have regulatory licenses and approval. We want to become much more than a traditional sales agency brokerage, building a better, more efficient business with more resilient and predictable earnings, moving closer to a fintech than what we were in the past. We want to provide advisory and multiple counterparty prime brokerage to our most sophisticated customers, right through to single brokerage and then digital self-serve for our smaller customers that don't need quite so much support. Clearly defined client segments, a broader product spread, including FX, payments, banking and finance. And we'll continue to bolster what's already a strong brand with a much broader reach, significant added capability as we reposition the business for exponential scale, driving shareholder value with full accountability and necessary transparency as a listed company that takes its responsibilities seriously. I hope you found that presentation helpful. We've tried to keep it punchy. We will be doing more of these in the future, but for now, let's move to any questions before drawing the session to a close. And I would just say to you, we do intend to engage with shareholders properly. We do have Mark leading the IR team now. We will have more of these sessions and get into a regular cadence. Forgive us the quietness over the last 6 months. That's not how we intend to look going forwards.
That's great. Thank you very much indeed, Jim, Guy, Mark. Let me, if I may, just bring up your cameras for the Q&A. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the guys take a few moments to review those questions submitted already, I'd just like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Mark, if I may just hand back to you just to read out any questions where it's appropriate to do so, and then if I may, pick up from you at the end.
Thanks, Mark. We've had some questions already. I would, as Mark said, encourage you to keep on submitting them. Here's the first one. With the guidance in your most recent RNS, it looks like revenue growth will fall 10%, whereas your competitors are forecast to grow around 20%. So this disappointing performance can't be blamed on general FX market conditions. You've invested in the business, so why hasn't the revenue growth come through as expected?
Thanks, Mark. I will take that question. I can't really talk about competitors, but I can explain why we've given the guidance where we have, and we touched on it earlier. As we saw in the second half of FY23 and through the start of FY24, a much lower risk environment, the product mix that we saw of our trading results was significantly more weighted to spots rather than forwards. And I think I mentioned before we had an FY22 a 60-40 mix, and actually we saw of forwards to spots, and we saw 60% spots, 40% forwards broadly in the last quarter of FY23 and in the first 2-3 months of this year. If we project that revenue mix forward, that's what drove where we put our outlook guidance. And as Jim has said, that is the only area where we generate revenues and fees, whereas perhaps some of our competitors have a broader product offering. But over to you, Jim.
I was going to say exactly that. You've got to compare eggs for eggs, and we've had a very narrow product offering historically. We're now broadening that out, and I think that will make us more comparable, particularly similarly of the technology platforms that we might be compared to, some of whom I think have been ahead of us in that race for a bigger tech stack.
Thanks both. If I go on to the next one, revenue per employee has been on the decline since you came to market. So what are all these new hires doing, particularly in the back office, where the increase has been 7 times since the IPO?
I think this talks very much to what we were saying earlier around the investment in infrastructure. The business chose to go down the MiFID II route. It's a more arduous route as regards regulatory adherence. Some of our competitors have stayed as payments business, EMI businesses, but nonetheless, if you choose that route, it allows you to do options, structured solutions. It allows you to provide forwards and complicated or more complicated products, sophisticated products for more sophisticated clients, institutional clients in particular. So the benefit of doing that has been that we've been able to create and curate, a very sizable and meaningful part of our business around institutional clients, which will be very helpful going forward as we invest in alternative banking. But the downside of that is it does require significant more infrastructure. And we've had to invest in that in order to get to this point in the platform.
If I go on to the next question, given the adverse market conditions experienced in 2023 and the beginning of 2024, how resilient do you believe the business is to future market volatility? What contingency plans are in place to mitigate such risks?
I think we've covered the main points here, haven't we? But partly it's cost control, and it's making sure that we really rein in those costs where we can. Sorry, Mark, would you mind just bring that back over here so I can see it? Sorry. And partly it's about making sure that we are broadening the offering and getting closer to our customers with all of the things that we've said. I think if we'd have stayed a very narrow offering business and just focused on FX, as our presentation clearly determined, we are at the sway of the market much more than we would like to be. So protecting against that is about broadening the offering, getting closer to customers, broadening our jurisdictions in terms of where we operate, because all markets have a different potential nuance in terms of how they respond to those macroeconomic events. Having more coverage helps, and all the things we're investing in are designed to give us that resilience rather than remain a business that's fundamentally at the sway of volatility.
Thanks, Jim. I have the next one is, do you have a need to raise funds again?
I mean, you never say never in these things, right? But we don't have any immediate plans to do so. We raised enough money to do what we need to do. We were very clear with shareholders who backed us, our institutional shareholders who backed us thoroughly to make an investment while preserving the cash, as Guy explained on those P&L and balance sheet slides. The importance of having that headroom between what we're supposed to have in the business and what we can trade with. So no, we're in a good place. We have a good amount of house cash on the balance sheet. We're not concerned about our cash levels. We have the capability to respond to volatility if it comes our way, which we anticipate that it probably will, with various elections and macroeconomic events being triggered in the news even as recently as last week when Macron made the announcement that he did.
Yeah, agreed. The next one I'll actually take, because why don't shareholders get regular RNS? I mean, if you don't mind me answering some of that. So we had a period where the management were focused obviously on the strategic review. And then as Jim said at the outset, we couldn't do this investor meet at the time of the results because we had the capital raise ongoing. But you should rest assured from all three of us that we are very committed to regular dialogue with shareholders going forward.
Absolutely. It's really important. And, we know we have an obligation to do that. So I also do read the share forums when I get time. We do try and have a sort of our eye on this heartbeat that you guys are very passionate about your investments, passionate about this business when you've invested in it. We understand that. We take it very seriously, and we are accessible. So you can be in contact with us. we will do more sessions like this, and we are happy to take your questions and answer them directly.
As we're doing so now, thanks, Jim. So the next question is, how does ARGENTEX plan to differentiate itself from competitors in the FX, payments and alternative banking sectors?
You might want to contribute to this, but I always think the best way to differentiate yourself from any competitor actually is in service, because products, sure, you can build something, but then somebody else can copy it, and that's always going to be part of the problem rather than the solution. So I think service matters. We've always been good at that. We've built a 50 million revenue platform on the back of service. That makes a huge difference to how we think about life. But we have not had enough product to be able to deliver to market when competitors were leaving us behind, frankly, in that sort of race for more technology and more provision for customers. So we're playing catch up. We're going to get there very aggressively, more aggressively than we've previously discussed. Hence the presentation and the focus and the fundraise. Ultimately, I think service matters as much as product, if not more so, and we intend to focus there more than ever.
Yeah. Jim, I think I'd add to that. I'd agree. It's absolutely, half the question says, how do you stop yourself being a me too? And I think the obvious point to this is, not only do you want to diversify our revenue stream, but we know that we have customers who absolutely value the very high level of expertise we have in supporting them manage risk in their business, which we do, but they also want complementary services from us as well. And so it's answering the question the same way, but this is not only do we think this is an excellent thing from us, from our perspective, to mitigate risk, give us a broader revenue generating areas, if you like, but also our customers want that and would like that service provision from us. So there's a push and a pull there, and we think it's the right thing to do.
People are a part of that too. You've got to keep your good people. You've got to hire carefully.
Yeah.
Quality matters if you are going to differentiate yourself with service levels with the most. Let's not forget, sophisticated clients out there. We deal at the high echelons of the corporate and institutional market. You don't get to win that business and keep that business without that quality. So I think we have formed there in a positive way. We intend to retain that strength going forwards, but by adding to that with greater functionality, better reporting for clients, more product for clients, and gravitate closer to them.
Thank you. We've had one or two questions around the capital increase. So with your permission, I'll sort of group them together. So the gist of both of them has been, communication was that the company could not survive without this additional capital, wasn't taking debt an option. Guy, do you want to start with that one?
Yeah, I think this was an evaluation by the board. We did consider taking debt, but the board felt much more comfortably that we need to maintain capital to support our underlying business. If we took on debt, actually from a regulatory capital requirement, it doesn't necessarily, it gets included and doesn't necessarily help our position versus raising money through cash.
Just to be clear, we don't need structural debt at all. So there was no requirement to bring structural debt into the business. The only thing I would say, I think Guy and I have discussed and we'd be open to developing an RCF facility to allow you to turn the taps on and off if volatility moves significantly. So because it's quite hard to predict, right? So what's the right Goldilocks amount of cash that you should hold in your business at any one time? It moves a lot, as we saw from those earlier slides. So structural debt, not necessary. A credit facility would potentially be of interest as we get larger, rather than using shareholder funds, which is potentially an inefficient use of capital to do that. But no, we don't need money to survive as a business, and anything that even comes close to that as a conversation is playing wrong.
Thank you both. Are there any plans for partnerships or collaborations with other fintech companies or financial institutions to enhance your service portfolio and market reach?
Yeah, it's a great question, that, David S. Yes, there are, but importantly, you have to have a platform that has the capability to connect with those partners. And historically, that's not what we've been able to do. So building out the platform, as we're now talking about, with API connectivity in particular, does open those opportunities significantly more broadly than we had the capacity to do beforehand. So it's not just clients that get the benefits of that upgrade, if you like, to the technology and to the platform. Actually, it's partnerships opportunities too. I'm a great believer in partnership opportunities and we've got quite a number of them in front of us already.
Yeah, and you know, if I give an example, if we have an enhanced platform with ready-built connectivity into it, there may well be other service providers out there, other fintech companies, for example, who have excellent bolt-ons that may be able, for example, modeling capabilities, which our clients may be able to use for us to illustrate better hedging options with them, for example, and that would be a great position to be into. So, you know, we recognise that we are in an environment, an ecosystem, where actually collaboration, working with others, is really how modern companies are evolving, and we have to give ourselves that capability to do it.
Yeah, it's not just a capacity thing, is it? As well, it's a mindset thing as well. And the other thing to say, it's not quite the same point, but it's probably related, and I hope you'll thank me for it. You don't have to build everything. You don't have to own everything. And we're not in any way close to the idea of renting technology if it gets us there faster. It's difficult with alternative banking provision in that, you know, there's nothing you can just buy off the shelf and launch. But with other services, trade credit would be an example. There are absolutely partnerships that you could form and would be in our minds to be able to deliver greater value out to consumers without necessarily distracting us to customers, without necessarily distracting us as a business. So yes, very open to that.
Which in a way sort of segues, although it's a different point, into the next question, which is, you said you want to become a more fintech company. How can I be sure you can compete with the existing fintechs? What are your advantage for clients vis-a-vis existing fintechs?
I think it's more hybrid than not, isn't it? You know, we were, you know, a rudimentary agency business in our roots. We're moving closer to the fintech space. We've made a fulsome commitment and a raise to invest in the provision of a digital banking solution for the alternative investment space. Who do you want to compare us to? You know, are we a technology business? No. Are we moving further up that spectrum? Absolutely. And that's part of broadening our opportunities, not just in partnerships, but geographically, but also in terms of product provision too.
Thank you. When do you anticipate the platform realignment will be complete?
It's not a cliff edge. So you know, you're sort of building one over here, you're upgrading one over here. There's bits of that you'll keep. There's bits of that you'll develop. So it's symbiotic. It's not you know, we get to there and in 9 months it's all rainbows and roses. It sort of doesn't quite happen like that. We are already offering, you know, virtual IBANs. We've been doing it for a little while. We already have a product offering and an engine around that. We're just expanding that. So it's not that cliff edge scenario. Our capability will increase day on day, week on week, month on month as we go through the process.
Back to dividends, perhaps, Guy. At what point would you start paying dividends?
Bit difficult because it's a board decision, isn't it? And I mean, your earlier point was when we start generating enough cash to do it.
Yeah, I mean, I think I'll expand. I mean, the board has clearly we've gone to raise money because we want to significantly invest in the business, and we're going to not pay the dividends in the short and medium term. I think if our plans deliver and we start to generate significant amounts of cash in the future, the board will clearly reconsider how it decides to allocate that to support growth and whether and how shareholder returns could happen. But I think, you know, and that is something we evaluated by the board at, you know, I'd say every 6 months and standard.
Yeah.
But to manage expectations, I think with the plan we've outlined, and we're quite clear if we're showing something on a 5-year roadmap, I would not anticipate that is going to be sort of a significant discussion for at least another 36 months.
Yeah, maybe. I mean, the only thing we ought to say, clearly, you know, if you are paying dividends to shareholders, you put yourself in a very favourable position with certain types of investors, and that can make, you know, quite the difference to your stock and to your shareholding value. Some of the product set that we're talking about developing does have the potential to generate significant amounts of cash. It depends on the environment, it depends on the deployment, it depends on interest rates and quite a few other things, but we are already starting to earn interest from some of the balances that are held as part of our new product deployment. So I wouldn't want to rule it out. I certainly wouldn't want to hold us to, oh, we're not going to do anything for 3 years, simply because one, it's a board decision, and two, things can change quite quickly if the results of our transformative strategy really start to play. So we want to do it. I think it's just a question of when it's right to do it, and we'll make the right decision for the company rather than leave it short of headroom in order to continue to use that money to underpin credit and build revenues further and faster.
Thank you. You may feel you've answered this one when we're talking about the need for a debt facility. How developed are your conversations with potential RCF providers?
So just to be clear, we don't need debt. We certainly don't need structural debt. RCF is interesting in that it gives us the ability to turn the taps on and turn the taps off in a much more flexible way. I just think it's a better use of balance sheet funds, frankly. So we have started discussions around RCF. There's no immediate requirement for it. It becomes more interesting as we get bigger as a business.
Yeah.
Thank you. I think we've probably covered most of the questions that have come in. What I would say is, we'd encourage all of us further dialogue. You can get hold of me via investorrelations@argentex.com, or indeed Guy or Jim directly. And with that, back to you, Mark.
That's great. Thank you very much indeed. And thank you once again to everybody for your engagement this morning. Guys, I know investor feedback will be particularly important to you, and I'll shortly redirect those on the call to give you their thoughts and expectations. But perhaps before I just redirect investors to give you their feedback, I could just ask you for a few short closing comments, maybe back to you, Jim.
Thanks, Mark. Appreciated. I think we've covered everything, but if you want me to sort of emphasize the key points from not just this presentation, but what we are doing on a day-to-day basis, we are trying to bring the business very much in line with the market opportunity it faces. It's a huge opportunity. We believe in it. We are fully committed to it on a permanent basis and for the long term. We wouldn't be as committed as that if we didn't truly believe in it. We're building a fabulous team around us. We've made a number of changes. Those changes will continue for as long as they need to do in order to put us in the best possible position to build real shareholder value. We appreciate that it's better to judge us on actions than it is on words. We're not much interested in being judged on words without necessary support from the things that we do rather than the things that we say. So judge us on results. We're happy to be judged in that way on a fully transparent basis.
That's great. Jim, Guy, Mark, thank you once again for updating investors. If I could please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure it'll be greatly valued by the company. On behalf of the management team of ARGENTEX Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.
Thank you.
Thank you.